Right now, Home Depot Inc. is trading at exactly 346.03 US dollars, taking a significant hit of $12, which translates to a downward move of roughly 3.35% on the day. If you are watching the charts this morning, you are seeing a massive red candle that pretty much sets the tone for the entire retail sector today. This isn't just a small fluctuation or the usual market noise. This is a decisive move lower that signals something much deeper is happening in the economy. When a giant like Home Depot sheds over 3% in a single session, it acts like a tremor that ripples through everything else, warning us that the consumer might finally be hitting a wall. Here is where the tension sits between what most investors expect from a stock like Home Depot and the cold reality of what is actually happening on the trading floor. The general expectation, the narrative you will hear from your average financial advisor or read in a standard newsletter, is that Home Depot is the ultimate safety play. It is supposed to be the boring, reliable anchor in your portfolio, a stock you buy for the dividend and then ignore while you stress out over the volatility of Tesla stock or the wild daily swings of Nvidia stock. People assume that because everyone needs to fix their toilets and patch their roofs, Home Depot is immune to the broader economic cycle. But the reality we are witnessing today is starkly different. The reality is that Home Depot has effectively become a high beta proxy for the American housing market, which is currently frozen solid. The stock is not acting like a defensive shield, it's acting like a warning siren. The drop we are seeing right now is a direct reaction to a quarterly earnings report that didn't just miss the mark, it exposed a fundamental weakness in the current consumer mindset. The company actually blamed a lack of storms for some of the weakness, which might sound like a convenient excuse, but when you peel back the layers, it reveals that unless nature forces a homeowner to spend money on repairs, they are keeping their wallets shut. This morning's price action is being driven by a combination of disappointing earnings and a slashed outlook for the rest of the year. When you see a blue-chip company cut its guidance, it forces every single major institution to reprice the stock immediately. If you log into your Fidelity trading platform or check the Interactive Brokers platform, you will see that the volume today is spiking well above average. This indicates that big funds are rotating out of the name, fearing that the bottom isn't in yet. It's fascinating to watch the divergence between how retail investors and institutional investors handle this. A retail trader using the Robinhood app might look at this drop and think it's a perfect buy the dip opportunity because the brand is so strong. They see a discount and instinctively want to grab shares. However, the institutional money, the capital controlled by Fidelity Wealth Management or large pension funds, is looking at the macroeconomic data and seeing a prolonged period of stagnation. They are worried that the higher-for-longer interest rate environment has effectively killed the renovation boom that fueled Home Depot's growth over the last few years. If you are holding individual brokerage accounts, you need to understand that this 3.35% drop is the market pricing in a recession in the housing sector, even if the broader economy claims to be doing fine. The core issue dragging the stock down to 346.03 today is the phenomenon known as the lock-in effect. This is something we need to discuss because it is the single biggest headwind for the home improvement industry. Millions of Americans are sitting on mortgages with rates under 3 or 4%. They have absolutely no incentive to sell their homes and move into a new place with a 7% mortgage. Because they aren't moving, they aren't doing those pre-sale renovations, and they aren't doing those post-purchase upgrades that usually drive massive sales for Home Depot. The housing turnover rate has plummeted. And without turnover, the demand for big-ticket items like flooring, cabinets, and appliances dries up. It's a fascinating dynamic because it defies the usual logic that says if people stay put, they will renovate. The data is showing us that if people stay put because they feel stuck financially, they actually spend less on the home. They do the bare minimum maintenance, which explains why the CEO is talking about a lack of weather-related demand. they are waiting for a pipe to burst before they spend a dime. This creates a very difficult environment for the stock, regardless of how efficient the company is. Let's talk about how this compares to other popular assets you might be watching. If you track Apple stock, you are used to watching consumer cycles based on product launches. A new iPhone comes out, sales spike, and the stock moves. With Home Depot, the cycle is tied to the Federal Reserve and the yield on the 10-year Treasury note. It's almost mathematical. If yields go up, Home Depot goes down. It's inversely correlated in a way that even Fidelity ETFs focused on real estate are struggling to manage. This is why you see such a sharp reaction today. It's not just about the company selling fewer hammers, it's about the cost of money. When borrowing money to redo a kitchen costs 10% or more, the return on investment for that renovation collapses. Homeowners are smart. They can do the math. They know that putting $50,000 into a kitchen right now might not add $50,000 of value to the home in a stagnant market, so they simply don't do it. This hesitation is what is bleeding into the stock price. I want you to take a second and think about your own spending habits or the habits of people you know. Comment below how many shares of Home Depot you currently hold, or if you are waiting for the price to drop even lower before starting a position. I am genuinely curious if you think the lack of storms excuse is valid, or if it's just corporate speak for we can't get people to spend money. It's always interesting to gauge the sentiment of actual investors versus what Wall Street analysts are writing in their reports. When we look at the mechanics of trading this stock, the platforms you choose can actually shape your perspective. For instance, if you use SoFi Invest or Schwab Intelligent Portfolios, you might be utilizing automated rebalancing. On a day like today where HD drops over 3%, those intelligent portfolio algorithms might automatically buy more shares to bring your allocation back in line. This passive flow can sometimes put a floor under the stock, preventing it from crashing 10%. On the other hand, active traders on interactive broker setups are likely shorting the stock or buying put options, betting that the pain is not over yet. It's fascinating to watch the divergence between how retail investors and institutional investors handle this. If you're doing self-investing through a Fidelity brokerage account, you have to make the active decision to hold or fold. That psychological pressure is intense when you see a blue-chip stock failing to hold support levels. We should also touch on the competitive landscape because Home Depot does not operate in a vacuum. When HD sneezes, Lowe's catches a cold. But Home Depot has always traded at a premium because of its pro business. This is a crucial distinction. Home Depot derives a massive chunk of its revenue from professional contractors, electricians, and plumbers, the pros. These aren't the weekend warriors buying a single can of paint. These are the guys buying drywall by the truckload every single morning. The expectation has always been that the pro business is recession-proof because things always break. But the reality appearing in today's numbers is that even the pros are seeing a slowdown. If the pros are billing fewer hours, they're buying fewer materials. This suggests that the slowdown isn't just in consumer DIY projects, it's hitting the commercial and professional maintenance side too. That's a much scarier prospect for the economy. It implies that businesses are deferring maintenance just like households are. Analyzing the financials briefly, the company's decision to trim its full-year profit outlook is the real kicker. Markets hate uncertainty, but they hate reduced guidance even more. It basically tells analysts, hey, our previous models were too optimistic, and the next few months are going to be rough. This forces a repricing of the price-to-earnings multiple. If earnings are going to be lower, the stock price has to come down to maintain a reasonable valuation. You can't trade at 22 or 23 times earnings if your growth is negative. This compression is what we are seeing at the 346.03 level. It's the market searching for a fair value multiple that accounts for zero or negative growth in the near term. Now, let's step back and look at what Home Depot actually does just to ground this analysis. Founded in the late 1970s, Home Depot invented the big box home improvement category. They operate huge warehouse-style stores that stock up to 40,000 different products. Their logistics network is a beast. They have distribution centers that can get products to stores incredibly fast, which has been their competitive moat against Amazon for years. It's very hard to ship a 12-foot piece of lumber or a 500-pound vanity via Amazon Prime efficiently. Home Depot leveraged its physical footprint to become a leader in the buy online, pick up in store model, which was a massive advantage during the pandemic. They have invested heavily in their digital platforms. Whether you are using the Fidelity mobile app to check their stock or the Home Depot app to check inventory, their digital integration is top tier. However, a great business model cannot outrun a bad economic environment.